morning. This is Horizon's Middle East and Africa. Our top stories this morning. Hormuz standoff. Oil rises for a fourth day as a U.S.-Iran stalemate drags on. Brent holds above $91 with little traffic moving through the strait. And Gulf tensions flare. The UAE accuses Iran of launching 2 ballistic missiles towards its territory. Abu Dhabi cuts trade and financial ties as Tehran rejects the allegation. And chipmakers sink. Asian stocks drop as the semiconductor sell-off deepens. Investors retreating from one of the year's hottest trades amid elevated bond yields and geopolitical uncertainty. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Risk off in markets this morning. You can see that in the U.S. futures picture, 1/10 lower. That follows negative closes in the S&P 500, the Nasdaq 100, and then the pain was really felt in the SOX gauge that dropped about 5%. So a retreat from that chip rally that we saw in the session prior to that, and really bringing into the light that question about those bond yields and the elevated yields that we saw over the past couple of days, and then whether that would affect spending by hyperscalers, that CapEx question back into the scene. And then, of course, that contagion is felt in Asian equities, 2% lower when it comes to the MSCI Asia Pacific. The Kospi was dropping more than 5%. It was fluctuating in these losses. We have Winnie in a second to talk to us about what exactly are the intricacies of the weakness we're seeing across Asia this morning. And of course, Brent crude, yet again, a fourth day of rallies in the green, again, holding above that $91 per barrel level as the stalemate in the Middle East continues in the war. President Trump said that Hormuz mines are now removed or detonated. Now, some ambiguity around what exactly that means or whether that is in fact true. And ultimately, there's just no sign of progress or clarity to ending the war after around 6 months of going through it. For the past couple of days, what we've been keeping an eye on is bonds globally, really. But U.S. 10-year yields are now roaming at 4.69%. That is almost the highest in over a year since early 2025. The 30-year yields were surging, of course, to the highest since 2007. We're keeping an eye on gilts as well that have surged. The yields on gilts, of course, have surged to the highest since 1998. Other European long yields were also at multi-decade highs, and we're monitoring similar movement in Asian equities, in Asian bonds in New Zealand and in Australia as well. Markets have practically gotten zero guidance from the Federal Reserve since the appointment of Kevin Warsh. So we look forward to those Fed minutes that come out later today for the FOMC meeting in July, and whether those will be a little bit more meaningful than ones we have gotten before. But for a deep dive into what is exactly happening in Asia this morning, we've got Winnie Su standing for us in Hong Kong. Winnie, what do you have for us?
Yeah, good morning, Abir. Well, we are seeing Asian stocks tracking those losses in U.S. peers overnight, and especially that's coming as the chip sell-off deepens, and we have higher oil prices, and of course, the elevated yield environment is really bad for tech stocks that really has their high valuation relying on the future earnings growth, and of course, some concerns around the rising borrowing costs as well, and that's why we are seeing MSCI Asia here down about 2%, having its worst day in about 3 weeks, with tech leading declines and the tech-heavy Kospi here, of course, down about 6%, as well as other tech gauges in Taiwan and Japan also following those declines. Now, flip forward, though, we take a look at the bright spot in today's market. It is that IPO from Unitree Robotics, and we saw shares jumping as much as about more than 600% at the open. Paired a bit, but we're still up about 480% here, and it is really showing lots of optimism, especially in the retail space. We had an oversubscription of over 5,000 times in the retail portion after the company raised about $904 million. Now, this is a very important IPO because it actually is China's very first publicly traded humanoid robot maker and potentially has a very important strategic role to play amid this whole AI race between Beijing and the U.S. Back to you, Abir.
All right, Bloomberg's Winnie Su in Hong Kong. She'll be back with us in 30 minutes or so. Now back to the regional story in oil, which is trading higher for a fourth day after President Trump insisted there are no ongoing talks with Iran. The standoff leaves the Strait of Hormuz in limbo, with traffic still a fraction of pre-war levels as Washington prepares to ramp up economic pressure on Tehran. For more on this story, we're now joined by Stuart Livingstone-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. Sir, good morning. President Trump says no talks ongoing or planned with Iran. Where does that leave the state of things in this war?
It depends who you listen to in the US administration. So that's what he says. His son-in-law says that talks are going on at multiple levels in the government. I suspect the truth is somewhere in between. It would be extraordinary if there wasn't some sort of communication, albeit we suspect via mediators. Quite what they're discussing, we don't know. But that seems to be the gist of it.
Okay. And we also spoke to Jake Sullivan, who's, of course, the former national security advisor under Joe Biden, who told us that Gulf countries or countries in the region may, in fact, have to step up and broker their own deals with Iran. Let's just take a listen to what he said.
Regional countries are feeling they need to step up to try to broker something themselves because, of course, their interests are deeply implicated in this. And what I would expect will happen as we go on is that these regional countries will try to cut their own deals with Iran to make their lives a little easier, even if over time that comes at the expense of the United States.
So you heard what he was just saying there. That is kind of a consensus among some analysts as well when it comes to what Gulf countries may need to do. And yesterday, of course, we all are here. We all heard those alerts on the ballistic missiles that the UAE said that it's cutting trade ties with Tehran. Just how realistic is it that countries in the Gulf or in the region would have to actually do their own deals with Iran?
I think it is quite realistic. I mean, the way I think about it is the following, which is that I would say the diplomatic skills of the countries in the region, and I'm thinking particularly about UAE and Qatar and Saudi, they have a much better understanding of the cultural sensitivities, they have a much better understanding of the reality on the ground, and they have a lot more to lose and or gain by cutting deals. Now, quite what those deals look like, what will those agreements be, we don't know exactly. But yes, I mean, I think ultimately after 6 months now of conflict and this ongoing closure or effective closure of Hormuz, clearly the motivation for them to get a deal done is pretty high.
Yeah. That is definitely evident, Stuart. Thank you, as always. Stuart Livingstone-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia, with that update. Now, still ahead, Fab Asset Management tells us why the upcoming release of the Fed's July meeting minutes is more consequential than usual. More details ahead. This is Bloomberg. Welcome back to Horizons Middle East and Africa. The chip sell-off is extending to Asia as semiconductor stocks came under pressure overnight. Investors are retreating from one of the year's hottest trades amid elevated bond yields and geopolitical uncertainty. So to discuss more on this story, we're now joined by Bloomberg Markets reporter Anthony Stevens. Anthony, good morning. Good to have you with us. The rout that we're seeing starting in the U.S. yesterday, extending into Asia this morning, arguably the reasons behind it this time are a little bit different. Can you walk us through what you're seeing?
Yeah, for the first time, we're seeing a bit of a transmission mechanism between higher yields and equities on the tech front, right? And the reason for that is there's so much debt being raised by the tech companies themselves, and there is so much equity issuance coming as well. So in short, there is a wall of paper that is coming to markets just as the risk-free rate increases. So there's a lot of pressure on equity valuations from both directions. There's a lot of competition for the incremental investor dollar in AI from the debt side of things. And people need to make space in portfolios for the upcoming IPOs of Anthropic and OpenAI that look increasingly likely because of the strong revenue numbers that they have issued or have been leaked to the market, right? So as a result, you have this dynamic where what am I doing with the existing holdings in tech? Should I make space to buy more debt or buy some of these new IPOs? And that's kind of what's bringing the rise in yields to the fore here. And you're seeing this big sell-off that's followed through from the big sell-off in the US. So you had the stocks down a lot last night, and you're seeing that across the board in Asia. So it's not just Japan, it's Korea, it's China, which normally trades in the other direction. So all three major AI markets are down together alongside some of the kind of high beta plays in Taiwan. So it's pretty much across the board, and that tells you it's more of a macro transmission mechanism more than a micro concern.
And Anthony, I was taking a look at bonds this morning and yesterday, really, and China kind of bucked the trend that is happening globally. And we're also seeing this blockbuster IPO, another one, Unitrees, that was surging more than 600%. It's now moderated slightly. What are you seeing in that?
This points to that IPO points to a pattern of consistent good performance on the China primary markets, right? Remember, that market attempts to list IPOs very much in retail's favor, and they continue to pay off. You know, we had a huge pop on the open. It's kind of moderated since, but it does show you that there's a lot more focus on the primary market in China than the existing listed place. So you see these IPOs do really well, even though the HS Tech Index, for example, has gone literally nowhere, and the Chinex Index struggles in and around the Kospi and Taiwan, right? So you have this kind of bifurcation where new issues in the AI space, in the robotic space, in the healthcare space do fantastically well because they're new and exciting, and they're priced really reasonably compared to maybe some of the US IPO methodologies, right? So that's almost like a gift to the retail from the Chinese tech companies. So that's doing really well. And it's important that they continue to do well as China looks to power its kind of technology growth with its capital markets. So, for example, we've heard reports that YMTC is coming to market soon. That is China's big NAND player. And it's important that all these different facets of the AI trade come together and are funded successfully on the equity markets to power China's AI progress.
All right, Anthony, thank you so much. Bloomberg Markets reporter Anthony Stevens joining us from Hong Kong. Now, treasuries are stabilizing following a global bond sell-off that pushed 10-year U.S. yields close to their highest level since early 2025. This is as Asian stocks are hit by a chip sell-off. Joining us now to discuss this and wider market moves is FAB Asset Management CIO Gareth Nicholson. Gareth, good to have you with us this morning. Just explain to me what is happening on the long-term yields. Is it an inflation story? Is it a Fed story? And why should the next FOMC minutes be more consequential?
Well, I'd love to join you. And as your previous speakers have highlighted, the biggest issue with the markets at the moment, particularly with fixed income, is clarity. And markets punish investors when there's not clarity. So one, we have an uneasy question around inflation. We still have the crisis happening on the ground, which is affecting oil. We see it affecting food and other supplies coming from Russia and Ukraine. This plus very, very hot temperatures across the world is seeing crop prices go up. So we have an issue and a focus around inflation. And bond markets don't like that. At the same time, we're not getting clarity from the Fed. So the biggest player in long-dated bonds is being quite quiet. The no forward guidance experiment that's going on is keeping a lot of investors in the dark. And this is why we're seeing that long part of the market really, really price in uncertainty. This lack of clarity is quite painful, and we're going to expect it to continue. And for us, this is where a lot of the focus will be going into Jackson Hole next week.
Okay. And Gareth, this has caught on, of course, to equities across the different spaces. I was taking a look at the SOX gauge, of course, down 5% yesterday. But technology stocks are a long-term growth bet. Does that mean that if we see yields escalating further higher, that will continue to weigh down on those hyperscalers?
Well, I think we've got to put it in context. Yes, for your first question, if long-dated bonds continue to rise, then the cushion, the risk-free rate, the starting point, if you would, for how much AI is getting funded through bonds is higher. Because we know that how it works is we have the treasury rate, and then on top of that, you've got additional credit spread for how strong the corporate is, how strong the AI corporate is. And those credit spreads have really got narrower and narrower. So there's not much cushion there for investors. So everyone's looking at the the rates, the treasury rate for the investment. Now, these levels have to be attractive for investors because this is funding growth. And if it's not funding the growth, we're not going to see the equity prices move. So they are really working in tandem at the moment, and this will remain when majority of the funding cost is driven by the treasuries and less by the credit spread. So whilst equity investors are watching earnings and the like, we still got to think where we're going to fund those. So it's becoming a very, very dynamic market where things in the bond markets are going to affect equities are going to affect credit spreads. So there's a lot going on.
But what would be the biggest pain, Gareth, if those long-term yields stay above that 5.3% level? Would it be mega cap tax? Would it be growth? Would it be something else?
Oh, it's going to affect so many. So we know that when there's fears around growth, high yield tends to be more sensitive. We're seeing high yield spreads very, very tight. So there's not much of a cushion for investors to say, yeah, I'm willing to take that because if it gets worse, it's fine. I'm getting paid for the risk. At the same time, IG, particularly long dated, has this very shaky tail through convexity. So long dated bonds are going to become more and more volatile. And you're not buying investment grade bonds for volatility. You're buying it for stability. So investors are saying, I'd rather go to the short end. I'd rather go to the front. Let me keep my money in cash. There's lots of opportunities coming. So both of them are facing trouble. So in the bond market, you've got to be super dynamic. You've got to be looking at other things like CLOs, ABS, and really mixing the dynamic to it.
Okay, but Gareth, just briefly coming back to the region, the stalemate in the war that is almost at its 6-month mark, are investors still underpricing the surging prices that we're seeing out of the effective closure of the Strait of Hormuz?
Well, I think inflation is going to become key focus going into the remaining part of the year. That's going to be looking at volatility around food, around oil. And as we know, the region is a large player in the space, particularly around food, energy, gas, fertilizer. We're going to go into the winter months, and we need to see how that's going to play out. A lot of places like Europe, for instance, they've struggled to create other channels for energy. You've got the low water levels, which are putting pressure on nuclear. So yes, the whole world is going to be looking at this region for more clarity. And as the speaker before highlighted, there are other channels. So we are constructive that clarity will come, but it's taking its time. Investors don't like time. So we're going to see the markets punishing investors through volatility. And as an investor, as a portfolio manager, this is where we've got to earn our keep through trying to mitigate those increased spells of uncertainty through hedges like convexity hedges, equity hedges, looking to diversify the bond holding, looking to move out of the key growth areas of AI only, still keeping them, but we've got to really work all the tools.
All right, Gareth, we're going to have to leave it there, but thank you, as always, for your time. Gareth Nicholson, CIO at FAB Asset Management. Now, coming up, 11th hour reprieve. President Trump pauses planned 50% tariffs on billions of dollars of Canadian goods. The details next. This is Bloomberg. Welcome back to Horizon's Middle East and Africa. President Trump has delayed planned 50% tariffs on billions of dollars of Canadian products for 3 days. The last-minute reprieve came in a Truth Social post, with Trump saying the two sides have reached a deal in principle. We're now joined by Bloomberg senior editor Derek Wolbank, joining us from San Francisco with more details. Derek, good to have you with us. We've got 3 days now to gain some clarity on this deal. How close do you think we are to a proper deal here, and is this genuine?
Donald Trump delayed tariffs on billions of dollars of Canadian products. There were supposed to be 50% tariffs, and walking up to the very deadline, just hours to go, it was unknown on both sides whether or not this was going to take effect or if there was going to be a sudden reprieve. The answer in a Truth Social post, sudden reprieve. It's 3 days long, and in those 3 days, we need to come to a deal of some sort. Trump said that this is close he said it's close. Let's say it that way. Subject to the finalization of documents was the exact way that he put it. We got a little bit of a different readout from Canadian Prime Minister Mark Carney. He wasn't quite as definitive. He said substantial progress has been made, although there is important work still to be done. Now, the trade dispute between the U.S. and Canada has ranged for quite a while, right? And it's a little bit difficult to say what all of this is kind of about sometimes. Canada has struggled to figure out exactly how to go back and forth with Trump. They've tried under Justin Trudeau to have sort of matching reciprocal tariffs, and they've tried under Mark Carney to take a little bit more of a conciliatory tone. They have been able to get some things done, but either which way they go, it does look like, time and again, things come forward and they get by there. So Canada's really trying to get to a point where it can sort of underline this and not have to do this all over again.
Derek, do you think that President Trump will try to take this time to leverage more concessions out of Canada?
I mean, it's certainly possible. Trump had talked in this post about the idea that that some oil pipeline might be part of this. It's been something he's wanted for a while. But at the same point, Trump, has mentioned a couple of other grievances that may or may not be within Mark Carney's remit to give. He's been mad about provincial bans on some American products. He's also been mad that Canadians sort of more broadly have reduced both their purchases of U.S. products at stores and also visits tourism to the United States in major places like, Las Vegas and South Florida, where Canadians have generally opted to kind of go other places, and you've seen declines. So there are some sort of sector-specific things that are there. I would expect the White House to be asking for some things in there, but Trump was a little vague on what exactly is going to be key to this, other than, as I say, oil pipeline.
Okay, Derek, we're going to have to leave it there, but thank you for that update. Bloomberg senior editor Derek Wallbank joining us on that tariff story. Now, coming up, oil continues to move amid Iran and U.S. stalemate. We will discuss the latest from global energy markets with Columbia University's Karen Young. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Hormuz standoff. Oil rises for a fourth day as the U.S.-Iran stalemate drags on. Brent holds above $91 with little traffic moving through the strait. Gulf tensions flare. The UAE accuses Iran of launching 2 ballistic missiles towards its territory. And Abu Dhabi cuts trade and financial ties as Tehran rejects the allegation. And chip makers sink. Asian stocks drop as the semiconductor sell-off deepens. Investors are retreating from one of the year's hottest trades amid elevated bond yields and geopolitical uncertainty. It has just gone 8:30 a.m. across the Emirates. I'm Amir in Dubai. Let's update you with another look at where risk assets are sitting this morning. Still risk off when it comes to the equity space, albeit S&P futures flat to the downside. That follows negative sessions in the S&P 500, in the Nasdaq 100, and most precisely in the SOX gauge, which dropped about 5% yesterday. That followed, of course, a positive session the day before. We've seen those moves throughout the past few months or so, but this time around, we're seeing really elevated bond yields across the world. We're not just looking at the United States, where the 30-year yields are at the highest since 2007, the 10-year yields the highest since early 2025, and that brings a lot of questions about what the Federal Reserve decides to do next. We await, of course, the FOMC meeting minutes for July and what clarity that sheds on the market. But then when it comes to Asian equities, 2.2% lower. The Kospi in South Korea is lower. Japanese equities were dropping as well. We saw a blockbuster debut in China, so that is some positive news where it surged more than 600%. That's Unitree, and now moderating some of those gains. And then, of course, Brent crude prices edging closer to that $92 on the barrel mark. The stalemate in the Middle East continues. The back and forth remarks do continue. Movement through the Strait of Hormuz does not continue. It is a fraction of where it was pre-war. So we continue to monitor whether those negotiations actually will happen between the United States and Iran. But for now, that stalemate is very real in the war that's been going on for about 6 months at this point. Let's continue with the oil story. Oil is rising for a fourth day as the U.S. and Iran show no signs of progress towards a peace deal after almost 6 months of conflict. The stalemate leaves the Strait of Hormuz in doubt, with little traffic transiting the waterway and pressuring global energy markets. So joining us now to discuss this is Karen Young, Senior Research Scholar at the Columbia University Center on Global Energy Policy. Karen, good morning. Good to have you with us this morning. I want to start with the stalemate. I want to start with what we've been really seeing over the past couple of days or so, that technical expiry for the MOU on Monday. Right now, I know I've asked you this question multiple times over the past few months, but who has more leverage at this time?
Well, thank you, Abir. Good to be with you. Again, we're in this kind of no peace, no war scenario. President Trump says that he wants to go back to economic pressure. So the new plan is very much like the old plan, the maximum pressure campaign that we saw under the first Trump administration. And that is going to put more price pressure, and less volumes are getting through the strait, as you say. And this is meant to put a pinch on Iranian revenues. But, you know, the Iranian leadership has shown resolve, and that they are willing to accept the pain of economic hardship and to pass that on to their citizens. What's different perhaps now in this new announcement from President Trump, and particularly from the Secretary of the Treasury, Scott Bessent, is that the willingness is to perhaps extend this onto third parties, or what we think of as secondary sanctions. So in the financial world, those firms that are helping to facilitate trade, we would expect then the pressure to mount. And this announcement, which you mentioned in the UAE, to kind of sever all trade and financial flow ties between the UAE and Iran, would be presumably part of that pressure.
Karen, just when it comes to those wider negotiations, we don't know if they're in fact going to take place. But Ghalibaf, who is the top Iran negotiator with the United States, said that from Iran's side, the Strait of Hormuz will not open unless the U.S. Stops all military operation, removes the naval blockade, and gives back the frozen assets as well as the oil sanctions. So ultimately, what I'm trying to ask here is, do you think that President Trump is ultimately going to have to make a deal, and it will be a bad deal?
Well, if President Trump wants Iran to back down, there will have to be concessions. And what Iran wants are access to frozen assets, and they want sanctions relief. So yes, that would be part of any negotiation. But that's not part of the talks right now, as far as we know. And so the sort of waiting game, and this sort of, game of chicken, who's going to blink first, or who's going to retaliate first, who is going to show that they are more willing to escalate. And that could very well be Iran, because President Trump has announced he wants to go the economic route, not the military route. He can always change his mind, but that's his plan for this week.
So do you think that's a coherent strategy, the economic isolation route?
Well, like I said, it's the new plan, but it's the old plan. It's been tried before, and Iran has successfully weathered that kind of economic pressure. Now, can it be done in a more sustained way? It's very difficult if you don't have a coalition, partners that are willing to enforce those kind of sanctions, and others who are, presumably buyers of Iranian oil and facilitators of Iranian financial transactions. They have to go along with that as well. And the U.S. will make, other countries potentially, really unhappy with that kind of decision.
Okay, Karen, let's just move on to the energy flows in the Strait of Hormuz that have been massively affected, of course, with the effective closure is what we've been calling it on the Strait of Hormuz. At what point do you think that those disruptions to Gulf supplies start to become structural rather than temporary premium risks?
I think that's already happening. I mean, we already see the restructuring of our energy system, what's happening in terms of the build out of new pipelines and new infrastructure to avoid the Strait of Hormuz. It will take time, but we're talking about a 2-year window. So, there are workarounds happening already, including production in other parts of the world. We've seen a massive increase of oil production in the Americas, in the United States, but also in places like Brazil, Guyana, even Venezuela, Argentina. And so the system is sort of working out other locations, other modes of transit. And certainly within the Persian Gulf, we're seeing the practices of different kinds of transit, turning off transponders, using these different routes, which is, risky and dangerous. And the kind of transfers from, inside the Persian Gulf to outside, the ship-to-ship transfers. All of these are new practices, new mechanisms within the oil trading system. And so I think we're going to see more of that. It's new infrastructure, it's new geographical locations of production, and new practices of sales and movement.
All right, Karen, we're going to have to leave it there, but appreciate your time as always. Karen Young, Senior Research Scholar at the Columbia University Center on Global Energy Policy. Now, Bank of Israel Governor Amir Yaron says the country's GDP is less than 1% below pre-war trends. Yaron told Bloomberg the country's economy has shown agility throughout the ongoing conflicts in the Middle East. Take a listen.
The Israeli economy and the Israeli people have shown great resiliency throughout the war. We've seen it in credit card expenditures, VC money coming in, export. It's part of the dynamic and agility of the economy. And in fact, the numbers I just said about GDP have brought GDP to be about just below 1% from its long-term pre-war trend. That, in reference to other wars, is a big accomplishment. The big fiscal challenge, however, ahead is managing what I call the fiscal trilemma. And any new entry government after the election will have to deal with it. And that is bringing Israel back on a path that is a declining debt, managing the defense expenditure, and obviously they will be derived partly from the map of security needs that will arise. And third, investing in growth expenditures, growth engines, and managing these three is going to be difficult. With it, there are going to be issues like how do you bring the ultra-Orthodox community back into the workforce? How do you draft them? These are social and political issues, but we have shown in the bank they have immense economic ramification as well.
So you have some idiosyncratic issues that you just laid out that you have to deal with, but other ones that Israel is facing are things the entire world is at the moment. The impact of higher oil prices, even though Israel might be a little bit more insulated. The impact of AI. Israel is certainly a hub for AI innovation. As you go to Jackson Hole, what do you expect to be the dominating big picture issue that you and your peers really need to discuss and maybe have hard conversations about?
I think part of it, AI is in the minds of everyone. Is it increasing productivity as we expect? Is it going to actually increase prices, or actually ultimately we're going to see the gains of productivity lowering inflation? Which one is going to come at what phase? That's obviously going to be one issue. And the other ones are, and related, are financial markets. You mentioned the high yields. Where are they going? Why are they moving the way they are? Are they expressing actually growth? Are they expressing inflation? These are the type of issues that I think will be discussed along the meeting.
That was the Bank of Israel governor speaking to Bloomberg's Danny Berger. Coming up, we will speak to the CEO of Absa Group as the South African bank accelerates expansion across the continent. That conversation is coming next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. South African bank Absa Group has reported an 8% increase in headline earnings to 12.8 billion rand in the first half of the year. The bank saw growth in its South African business, which offset a decline in profit from operations elsewhere on the continent. Our Chief Africa correspondent Jennifer Zapasaja joins us now from Johannesburg. Jen?
Yeah, thanks so much, Abir. With me now is Kenny Fihla, the CEO of Absa Group. Kenny, thanks so much for your time. So let's just start here. Abir was saying you announced your results yesterday. We saw a bit of green shoots here in South Africa, which offset some of the declines elsewhere in Africa. And yet you have ambitions to expand across the continent. Can you just speak to what that plan looks like and how much is actually in motion at this point?
Thank you, Jennifer. I think our plan is progressing exceptionally well. We are in the process of integrating the operations that we bought from Stan Church in Uganda. We are also consolidating our two businesses in Tanzania, and that work is already underway. We have applied for a representative office in Angola, and we intend to enter that market as well. In addition, we've got a rep office in Nigeria, which we are exploring the possibilities of converting into a merchant banking license. So clearly we have to continue to diversify our presence in the African continent as we see that as a massive growth opportunity.
How much have you seen, Kenny, the conflict in the Middle East potentially creating some headwinds to that ambition or potentially opening up opportunities, which I know you said during the earnings results yesterday?
Definitely created headwinds in the first instance, in that the level of client activity that we were seeing in the past subsided slightly, which also meant that from a trading point of view, our global market business did not do as well as was the case, say, in the first quarter of the year. Global markets still grew by sort of 8%, but we think that growth would have been significantly higher if it was not for the Middle Eastern sort of war. Secondly, there has been some headwinds in Ghana and Kenya in particular, resulting from a massive decline in interest rate. That seems to have plateaued at the moment, and we think that that puts then a very, very good foundation for us to grow as we think about 2027. Outside of those two headwinds, the business is robust, client numbers are growing, and we continue to do exceptionally well in South Africa, where our headline earnings grew by 17%.
Are you concerned, though, Kenny, about the reliance on markets like Kenya and Ghana? How do you anticipate or expect to grow some of your earnings in those countries, considering some of the headwinds that you were just pointing out there with interest rates?
I think we have to accelerate the diversification of our business. We've got many African markets that have huge potentials. If we think about the infrastructure development that is taking place in Tanzania, clearly we think there's a lot that we can do in that market. We also think that there's a lot that we can do in markets like Uganda, like Zambia, and also Angola, which is why we are intending to enter into the Angolan market. the dependence on 2 or 3 big markets is fine if you've got tailwinds. But as soon as you experience some headwinds, you are vulnerable to massive shocks, which is why then the primary thrust of our strategy is to diversify our revenue streams, both in terms of geographies, in terms of business lines, but also in terms of client segments. And we think there are huge opportunities in our business banking as well as in our personal banking space to increase our market share in some of the markets that we operate in.
Let's come to South Africa, because you did cut your GDP growth target to 1.5% in 2026. Many banks have also done so. The IMF, though, has about 1.1%. Do you attribute potentially the rosier outlook to some of the structural reforms? And are you actually seeing this show up in the business yet, or not at this point?
We are definitely seeing progress. The reforms that have taken place in the electricity sector have resulted in a massive growth in our own asset book in support of renewable energy initiatives. We think that progress ought to continue as government consolidates the unbundling of Eskom, separating it into generation, transmission, and distribution. That alone will trigger a massive investment in the development of the transmission infrastructure and networks. We're also seeing reforms taking place in the logistics sector, unlocking the potential of our rail infrastructure, which will then promote exports and allow particularly our mining companies and those who produce commodities, bulk or soft or hard commodities, to be able to access the export market. The export capacity of South Africa has been constrained largely by logistical problems and bottlenecks. By just unlocking that and making it more efficient, we think that will increase the productive sector and accelerate the economic growth. We're also seeing some changes that are quite positive in a number of areas, how government partners with business, broadly speaking, and how it is starting to think about leveraging the private sector capability to accelerate economic growth and improve government delivery on a number of social services.
Well, we have to leave it there with you. Always appreciate your time. Kenny Fihla, the CEO of Absa Group, joining us there in Johannesburg. Kenny, thank you so much for your time. Abir?
Jen, great conversation with us. Of course, Bloomberg's Jennifer Salpasach, our Chief Africa correspondent, with the CEO of Absa Group. Now, coming up, we will take a deep dive into the EU's efforts to rebuild its tech autonomy, a plan that may need at least $3 trillion. More on that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Brussels has pledged to spend 30 billion euros to build 7 AI gigafactories across Europe. But Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient when it comes to technology. So joining us now to discuss this is our Chief Europe correspondent, Oliver Crook. Ollie, back at the studio today, but with an important story. So can you just walk us through what this path to AI and tech autonomy in Europe will look like?
Yeah, absolutely, Abir. I mean, it's something we talk a lot about here in Europe, about autonomy on a number of different sort of strategic levels. Obviously, defense has been sort of front and center. But of course, the technology and AI seen by many as just as important, if not even potentially more important in terms of economic growth for the future and trying to gain some autonomy there. But what's been instructive here is that Bloomberg Intelligence has broken down what that will actually cost and in what sectors that money actually needs to be invested. And as you mentioned there, it's a pretty hefty bill. We're talking about a $3 trillion investment through 2035. That is going to be mostly concentrated in sort of one of the greatest deficiencies, which, as you can see there, is cloud infrastructure, where Europe is very, very dependent on outside countries, particularly the United States. The semi-cap equipment overall will take about a $500 billion investment. This is an area in which there is some autonomy by the Europeans. There actually is a fairly strong semiconductor manufacturing operation within Europe, but they don't make the hyper-advanced AI chips. They make things that go into basically industrial industrial processes, go into cars, they go into sort of smart appliances, things like that. Another $500 billion will have to be spent over on foundries. And of course, the last one there, the large language models, about $300 billion worth of investment, because the Europeans don't really have a major player within the large language model space, with the exception of the French company Mistral. And you can see that represented in European market share for large language models, which approximately now have 11% of the market share, which is far below 88%, which is going to be mostly dominated by the United States and China. The one good news for the Europeans is that they are sort of dominant in one critical space, and that is the machines that actually make the chips themselves. That is ASML, that makes those lithography machines, basically totally dominant in that market. But again, that is only one sort of part of the ecosystem, and in order to gain autonomy, you need to have much more control. And to say that even if all things go as according to plan by this Bloomberg intelligence, that still will not get the Europeans full autonomy, but it'll certainly move them forward significantly.
Okay, Ollie, just quickly, beyond technology, how realistic is a fully autonomous Europe? Critically, how much would it cost?
Yeah, exactly. I mean, listen, if $3 trillion sounds like a lot of money, to get sort of broader autonomy, it's going to cost $14 trillion through 2035. And these are the kinds of investments that are going to be very, very competitive to make here in Europe. They're going to have to be in defense. They're going to have to be in energy. They're going to have to be in the power grid, the AI and technology tools, as we've been discussing. Of course, we've been talking about climate for the last couple of weeks. You need to insulate against that. And you can see there represented on the screen, a failure to do that may blow out that GDP gap that we've been seeing spreading between China, between the United States, and of course, Europe.
All right, Oliver, we're going to have to leave it there. And that is it for Horizon's Middle East and Africa today. Keep it here with us for Daybreak Europe. This is Bloomberg.